Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we're looking at Terry Smith. Terry Smith is a fund manager. He's based in the United Kingdom. He is a super investor. He manages a lot of money. And one thing I like about this guy is he has a very simple strategy. So what I would like to do today is look at his strategy and give you 5 companies that are Sharia compliant that are in his portfolio, and then I'm going to share with you guys the rest of the portfolio. The reason I like to do these guys, basically look at these super investors, is because their strategy. Like, we are new to investing. We don't have a lot of money. These guys manage a lot of money and they try to find quality companies, and that's his strategy, find quality companies and so on. So what I'm going to do first is basically give you his strategy and talk about that, and then after that we will look at the 5 stocks, and then after that I'm going to show you his entire portfolio, and we will look at some of the Sharia compliant within that 15 or 20 whatever stocks that he owns. Okay, but before we do that, as always, please give the videos a like. It actually takes a lot of time. In fact, I recorded this video yesterday night and then I was about to post it this morning. I edited this morning and then I realized the sound was absolutely terrible. This one I think it might be better, but it might not be perfect, so I apologize if it's actually all over the place. I'm trying to figure out what's wrong with the mic. I think it's something to do with the computer or the mic. I'm gonna figure out today anyway. I'll fix it. But yeah, it takes a lot of time, I'll be honest with you, to do this research and so on. So it'd be really nice if you can just give the video a like. It doesn't cost you anything. And something that costs you a little bit is the fact that you can potentially join us on the Patreon account, okay, where you get access to all of these things, all the trackers that we have, and the Sharia compliant investing ebook and so on. So yeah, that really helps the channel. So if you can do that, that would be really nice. Okay, Terry Smith is this guy. He is basically based in the United Kingdom. He has a Fundsmith, basically a company called Fundsmith. He actually manages it. Quite a lot of money. So what I want to do now is go over his strategy first. So his strategy is very simple. He says investors should have a high quality concentrated portfolio of 20 to 30 resilient global growth companies which are held for the long term. Absolutely amazing. Okay, that's what I'm trying to do. Find high quality companies, 20 to 30 different companies, okay, global growth companies. Mine maybe is not global, but it is mainly focused in the US and so on, and held for the long term. And that's something I'm trying to do. And this is something that's really difficult, okay, especially if you're a new investor and you find a company and before you know it goes down 2, 3, 4%. It's hard to keep that company and keep going and keep adding to it. So the long term is really the hardest. That psychology of just forgetting about it and buy and forget, it's actually very hard. 3 things that he talks about, very, very simple. Buy good companies, and he has his basically metrics that he uses to buy good companies. So one of those things is basically looking at what is called return on invested capital and so on. He says don't overpay, and this is really important to us because there are so many companies out there, for example the Nvidias and so on. You will see it going up 3, 4, 5% every single day, and you think, okay, you know what, I'm gonna buy this company regardless of what is trading right now, how expensive it is. A lot of us will jump on the bandwagon and later on lose a lot of money. So don't overpay, because sometimes you're never gonna get that money. I've had companies that I bought when they're really expensive and I lost quite a bit of money. I bought companies when they were really cheap and made a lot of money. So it is important to think about that, okay? And do nothing. And that's again going back to the long term. Do absolutely nothing. This doesn't mean basically don't do completely anything at all, but it is important to ignore the noise. Don't follow that. If you want to rebalance your portfolio and things like that, that's fine. If there's a stock that you no longer believe is going to be basically what you want and so on, then get rid of it. Do those things, okay? But when it comes to the noise and the stock market is going down and is this going to be recession, don't listen to the news. Do nothing. Don't worry about these things, okay? A couple of more things that he talks about basically buying and investing in a business with the tangible assets, okay? Companies that we normally know, the companies that have a product that we can touch and feel and we know what it is, okay? Invest in a business with a growth potential, obviously, okay? We want to buy companies that has a growth potential, that grow in their revenue. If a company is not growing their revenues, they're not growing their cash flows, for example, okay? And that's not gonna be good for us, because what you want to end up doing is buy a quality company. They make money by basically selling products and services. Some of that money then goes into their cash flow. That cash flow then is used to pay you dividends, to buy back their own shares, to reinvest in the business, to pay off debt, and so on. So it is really important. Invest in a business that requires no significant leverage to generate returns. The company are not running to the bank every time they want to basically grow the business. Okay, they basically don't want to get capital from the bank. They grow organically. They use their own money. They use their own cash, and that's important. And he says avoid businesses that are vulnerable to technology innovation. Again, there are a lot of companies that lost business completely because some guy came up with a software that allows them to do what they were supposed to do for whatever, and completely wiped that company out of basically this world. Okay, and finally, invest for the long term, and that is simple. So he has those simple things that actually makes sense. And this is the reason I like, because I like simple things. I don't want to overcomplicate. That's why I use simple metrics when I actually basically talk about basically fundamentals of a business and so on. So make it simple. Okay, buy quality companies. Okay, don't overpay and hold them for the long time. If you could do that, then he says you'll be successful. Now let's have a look at the 5 companies that he owns in his portfolio. Then I'm going to show you the entire portfolio. And the first company he has is a company called IDEX Corporations, and this company basically has a market cap of 16.5 billion. So it's a small company. It has a narrow economic moat, and price is right now $219 per share. It does some pay dividends, 1.16 dividend payout ratio is only 29%, and the latest increase was about 7%. The 5-year growth rate of 10%. They have increased this dividend for just 2 years, so they are still quite new in terms of dividend side of things, increasing dividends. Okay, annual payout is $2.56, safety 95%. This comes from Simply Safe Dividend. Profit margin was about 18%, return on equity about 19%, return on invested capital is actually 13.8. This is something that he looks for all the time. Okay, return on invested capital is very important to Terry Smith. Now, free cash flow, we're looking about just about 500 million, and the reason is because the company is actually quite small company, so that's not bad at all. And total return we're looking at for the last 10 years, we're looking at about 15%. Next year they're expecting 9% growth, and then 12% after that is 1% discount based, and at the time of recording, $217 per share is where the price should be in the long run. Okay. Now, MasterCard is the next one. 370 billion market cap, wide economic moat. Okay, by the way, before I move on, MasterCard and Visa, both companies are not are basically Sharia compliant. They are not banks. Okay, they don't deal with anything like that. Their job is to make sure that transaction happens. They are the technology behind the cards that we have. They don't deal with any of the transactions. Basically, they don't basically charge riba or anything like that, interest and so on. They are purely like company that works behind the scenes that facilitates the transactions, if you like. As you can see, they have a very small dividend. Okay, payout ratio is only 20%. Latest increase was 16%. 5-year growth rate 18%. Dividend streak of 11 years, $2.28 is what you will get. Safety is 99%, which is the highest you can get. Profit margin of 43. Return on equity of 174. Return on invested capital, maybe this is why he's investing in this company, is actually 51%. Free cash flow $5 billion. Total return 20% in the last 10 years. Next year they're expecting the earnings to grow about 20%, then 17% every single year after that. It's about basically right now 1% discounted at the time of recording. $389 per share is where the price is. Next one is Visa. He owns both of them, which is very interesting. $483 billion, very similar in terms of basically where the company is. Also dividends very similar. The growth payout ratio is actually quite similar. The latest increase is about 20%, so Visa has got that upper hand when it comes to that. The 5-year growth rate 18%, both of them, and Visa is actually increased that dividend 14 years, and they pay slightly less, $1.80 per share. Now in terms of safety, it's also 99%, profit margin 51%, return on equity 45%, and return on invested capital is actually 28%. Free cash flow, we're looking at about $18 billion, which was quite a lot. Total return in the last 10 years, we're looking at about 19%. Next year, they're expecting the earnings to grow. This comes from the Yahoo analyst, so they're expecting the earnings to grow about 19 and 13.5%. Then about 13.5% almost every single year for the following 5 years. It's about 2% discounted right now. $241 per share is where the price should be. Next one is Procter & Gamble, and this is a company that he bought heavily this quarter, so I'll show you that in a second. But as you know, this company is one of the biggest companies out there. $359 billion market cap. It has wide economic moat, $152 per share right now. Dividend yield of 2.407, almost 2.5. Payout ratio 62%. So this is a bit high for my liking. What basically this means is they're using 62% of their net income to pay us these dividends. So this is a little bit high, but I'm hoping that in the next few quarters that they can bring that down. Latest increase about 3%, 5-year growth rate of 6%, dividend streak of 67%. So look at this. They have increased their dividend for 67 years, sorry. Okay, 67 years in a row. There was recessions, the war, this, that, they didn't care. They have increased it every single year. And this is why I like this type of business. They are very predictable. They steady Eddie kind of business. They have been increasing the dividends for a long time. You can rely on that dividend. Okay. But yeah, so $3.76 is basically what they will give you for every share of this company you own, and 99% safety, profit margin of 17.5%, return on equity 32%, return on invested capital 18%. $13 billion in the bank right now. Total return in the last 10 years is about basically 9%. Next year they're expecting the earnings to grow 8%, 6% after that. It's 12% premium right now. $136 per share is where the price is at. Next one is a company that I also own, that is automatic data processing. $103 billion market cap. It has a wide economic moat, $251 per share right now. The dividend is just below 2%, sorry. 58% when it comes to payout ratio. Latest increase was 20%, which is absolutely huge. 5-year growth rate of 14%, dividend streak of 49. So this means this company will become dividend kings if they increase it one more year. That dividend kings are companies that have increased their dividend 50 years plus, and dividend aristocrats are 25 years or above, and dividend contenders, I think they call these days, they are companies that are 10 plus years. Annual payout, we're looking about $5 for every share of this company that you own. Safety is 97%, profit margin almost 19%, return on equity 106%, return on invested capital 53%, and free cash flow we're looking at 3.64. Basically total return basically in the last 10 years we're looking at about 15%. Next year they're expecting the earnings to grow 10%, then 14% after that. 3% premium right now, $244 per share. I'm hoping the way the market is going right now, we might see a drop in this in the next couple of weeks or so. It looks like we're getting into like a bearish kind of market, so I'm expecting maybe the little bit of a pullback from this company. Hopefully then I can add a few more shares. Now that's the 5 companies I wanted to share with you guys, and all of them are Sharia compliant. So as you can see here, there are no issues when it comes to Sharia compliant. You can pause the video and have a look at that. Now let's have a look at his entire portfolio. So you can see here, he's actually the Q2, which is basically the recent report they've done. They have actually added more. So this is the Terry Smith Fund Smith. Okay, so they added more of Procter & Gamble. They added more MasterCard. They added this as well as what else they have added, Visa, okay, and a few other companies. It was interesting to see they've actually added to Stryker, because I thought Stryker was really expensive, and Procter & Gamble, I'll be honest with you, but Procter & Gamble is probably cheaper than Stryker. Stryker is very similar to Medtronic. They sell basically the medical equipment. So, but as you can see here, they've reduced a little bit of each one of these companies. So Alphabet, and I don't blame him, because these companies have gone up quite a bit. Microsoft has gone up, Meta has gone up quite a bit, Pepsi has gone up quite a bit as well, Nike, and he's even basically reduced automatic data processing and so on. So he's just sold a tiny bit of these companies and bought more of these companies here, which is very interesting. And if you wanted to check, I will put this on the links in the description section, so you can have a look at that. This company is interesting. It's actually gone down quite a bit, so I'm not sure why. He probably bought it a long time ago and it's still up quite a bit, but he took some profit, I think, over there. But let me have a look at the Striker, because I'm interested in Striker. Look, yeah, 28% premium according to Morningstar, and according to Seeking Alpha is about 13% upside according to the Wall Street. But Seeking Alpha analysts are saying basically it's not a buy right now, it's a hold. Quant is actually also saying it's a hold. So valuation is very rich when it comes to that company. But there you have it. That is the 5 companies I wanted to share with you guys. That is the strategy of this guy that I wanted to share with you guys. It's really important just to like look at this and just think about this. Okay, buy good companies, don't overpay, do nothing, hold on to your investment and leave it. Just to be transparent, okay, I do own automatic data processing there, about 13 shares. What else do I own? I own companies like Microsoft that I just mentioned. I've talked about Nike a little bit, but Procter & Gamble is one of the companies that we looked at. I do own that one. And what else do I own? I think that's and Visa. Okay, that's basically the 3 companies that I own that we talked about today in more details. I hope you're having a wonderful day. If you're still here, give the videos a like, subscribe to the channel, let me know if you have any questions, and definitely join us in the Discord. It really genuinely helps the channel. Have a wonderful day. Assalamu Alaikum.